In this video, I want to consider the drawback, the disadvantages of investing in common stocks. Number one is high risk. Common stocks are known to fluctuate, at a relatively high, pace compared to other forms of investments. And not only that, this particular behavior of fluctuation would invariably impact the value of your investment over the long run. When stocks fluctuate up and down, when it goes up and when it comes down, well, you tend to your investment tends to lose value. You can't do much because that is what common stock investing is all about. It fluctuates rapidly. It goes up and as well can equally come down within a short period of time. So it's risky in when you compare to other investments like real estate, and some other asset classes also. Number two, no guaranteed returns. There's no guarantee that you are going to have something, as a form of returns at the end of the day. Sometimes, the economy can affect a given stock, the interest rates can affect a stock, the political environment can equally affect a given stock, and by so doing, the stock may decide to, or the company may decide not to provide dividends as a result of such occurrences. There's no guaranteed returns, when it comes to investing in common stocks. Is quite risky. A company may decide not to pay dividends. They're not compelled by law to do so. And so you make up your mind that you should be able to bear the risk as it would be common stock investor, or else I will advise you look into other forms of investments. Number three, last in line for assets. When it comes to the asset of the company, if the company goes bankrupt or is liquidated, the common shareholders are the ones to be paid last after all debts and liabilities have been settled. Whatever remains from remains from the assets will be paid to common stockholders after bondholders, debenture holders, preferred stockholders have gotten their share. What and if anything remains at the end of the day, then the common stockholders will get to keep that. But if nothing remains at the end of it all, that is just a reality of being a common shareholder in the company. Number four, dividend uncertainty. Dividends actually may not be paid regularly. Sometimes a company, probably because of prevailing market condition, prevailing economic condition, maybe due to a decline in profitability, the company may be facing hard times. In that respect, that regards, the company may not be able to pay dividends or might decide to reduce or cut down on the amount it would have paid out as dividends. And so you discover that the income, of the investor is negatively impacted as a result of such decision. Number five, market volatility. The market sometimes can be very volatile, and that impacts the investment, value of a common stockholder. When the market is up, the common stockholder will benefit, and when the market is down, unfortunately, the common stockholder is bound to incur significant level of losses. That's the reality of the markets. It should not scare us. As long as the advantages are there, we equally need to be familiar with the disadvantages. It will go along with helping us to make informed decisions as investors. Number six, limited control. Although common stockholders have a voting right, they can vote during annual general meetings as it relates to as it relates to decisions that will impact how the company is run and governed. When it comes to the day-to-day running of the company, the shareholder has no influence over what is done in the company on a day-to-day basis. Only institutional investors, have the ability, the capacity to be able to influence how a company is run on a daily basis. So the investor, he is handicapped. Is at the mercy of whatsoever the board of directors or the company insiders decide to do at any given point in time. Number 7, potential for emotional decision making. Whenever the market is tends to go haywire, fluctuating or whatsoever, it's heart churning, stomach churning kind of. You discover that the investor may not sleep very well at night. It might affect the person psychologically. The investor might be tempted to sell at a loss. The phenomenon of buying high and selling low may set in. And so there's that potential for one to take a decision that is inherently anchored on emotion. So that will not go well with a common stock investor at the end of the day. That's a typical drawback of being a shareholder when the market is going down and down with no immediate recovery in sight. One could be tempted to just dump your shares, dispose your holdings, and then take whatever loss that accrues. Number 8, dilution of ownership. Usually, a company may decide to raise capital, and when it does that, you discover that your ownership in the company is diluted. The more capital the company raises, the less of the company shares you are going to have. Something of that nature happened to me sometimes back. Currently in my country, Nigeria, the banks are undertaking a kind of recapitalization. The central bank, kind of directed the banks to increase their capital base. And you discover that a bank may be doing very, very well based on this current based on this current shares outstanding. And whenever the results of the capital raise is released, you discover that additional shares will be added to the outstanding shares, and that will then cause one's investment to go down. You have that particular because of the diluted kind of shares coming in. You discover that the earning per shares will equally head south. It becomes smaller and smaller, and then before you understand, it may not be as strong as what it's expected to be. That's a disadvantage we should consider as beginning investors or individual investors or experienced investors. We should consider that at the back of our minds. Please subscribe to this channel, and I will be encouraged to bring you content of this nature. Don't forget to like this video and also comment in the comment section. It will go a long way in helping me to meet my goal as an educator kind of in YouTube. Then number 9, tax implication. Common stocks are exposed to taxes, though capital gain tax may not be much, but if the investor is compelled to sell, then of course that particular proceed will be taxed at a higher rate. So taxation equally affects common shareholders at every point in time. Number 10, complexity and time consuming. Actually, as an investor, you don't just expect to do very well in the markets without putting in the effort. And the effort here will involve regular research, regular examination of the market condition, trends in the market, You are conversant with events around the companies you invested in. You are equally up to date when it comes to, market news. And so it's time consuming, and of course it's a complicated process. That's why if you're not comfortable with this, I will advise you invest in an index fund, in a passively managed index, so you don't get to do anything. You simply relax and enjoy the proceeds the market gives you. You don't really seek to outperform or beat the market. You are just there to be content with whatever returns the market gives you. That is what we need to consider as common stockholders.